So we've got a U.S. Federal Reserve Chief Jerome Powell. He's on a tightrope right now as the next FOMC rate-setting meeting looms over the next 2 weeks. The Fed chief was speaking at the Economics Club in Washington a few hours ago today, touching on the state of the U.S. economy, what the Fed is doing, and lots more. Let's grab an excerpt.
It was really a very sad day for our country. Political violence has no place in our society, and I condemn it in the strongest terms. I know we all do. A man died at a political rally. 2 other people were critically injured. It's just a sad day. And I'll say that I'm grateful that the injuries to the former president were not more serious. I'd rather not comment on the markets. It's too...
Okay. So let's get another answer that you don't want to give.
No foreplay, huh?
So there are a few billion people in the world who are waiting to see what interest rates are going to be doing. Do you have any insights on where interest rates might be going?
So I'm going to take that as a great opportunity to talk a little bit about the economy and then talk about where that leaves us with policy. So I would just start by saying that the U.S. economy has performed really remarkably well over the last couple of years. 2023, last year, was a year in which the economy grew well above 3%. The labor market remained very strong, unemployment remained very low, and inflation came down at quite a sharp pace, particularly in the second half of the year, by a very large amount. And that forecast was almost unheard of. It was unheard of before 2023. So big upside surprise that year. This year, we had expected the economy to slow a bit gradually, the labor market to continue to gradually cool off after being overheated a couple of years ago, and inflation to continue to make progress. And something like that is basically what has happened. The economy is growing now at about 1.5% in the first half of the year. Most forecasters have about a 2% growth rate for the full year. The labor market, again, has moved into better and better balance to the point where I think you can now say it's essentially no tighter than it was in 2019 before the pandemic. Remember that the labor market of 2019 was a very strong labor market. So we're back to that place, no longer overheated. On inflation, in the first quarter, we didn't make any more progress. The second quarter, actually, we did make some more progress. We've had now 3 better readings, and if you average them, that's a pretty good pace. So turning to policy, your question, what we've said is that we didn't think it would be appropriate to begin to loosen policy until we had greater confidence that inflation was moving sustainably down to 2%. We've been waiting on that, and I would say we didn't gain any additional confidence in the first quarter, but the 3 readings in the second quarter, including the one from last week, do add somewhat to confidence. We've also said that we're a dual mandate bank. For a long time since inflation arrived, it's been appropriate to focus mainly on inflation. But now that inflation has come down and the labor market has indeed cooled off, we're going to be looking at both mandates. They're in much better balance. And that means that if we were to see an unexpected weakening in the labor market, then that might also be a reason for reaction by us.
Okay, I think I understand. So to put it in terms I can for sure understand, the markets are suggesting, the futures markets, that there's a 90% chance that the Fed will lower its discount rate in September. Do you think the markets know what they're talking about?
So today I'm not going to be sending any signals one way or the other on any particular meeting. So just to ruin the fun right at the beginning. I simply, we're going to make these decisions meeting by meeting, and we're going to make them on the basis of the data as they come in, the evolving data, the evolving outlook, and also the balance of risks now that the 2 mandates are basically close to being in balance.
All right, there are some people who say that the Fed would not like to lower interest rates in a presidential campaign period because you could be criticized for helping one party or another. Do you have any comment on whether that's an accurate view?
I do. So our undertaking at all times is that we'll make our decisions based on the incoming data, the evolving outlook, balance of risks, and only on that. We don't take political considerations into account. We don't put up a political filter on our decisions. It's hard enough to make these decisions based on the appropriate factors. If you're going to add a whole different filter in an area where we're not experts, it's not going to improve the quality of our decisions. And it's also not the orders we have from Congress. Our orders from Congress are to use our tools to foster maximum employment and price stability, and to do so without political considerations. That's what we're always going to do. If you look at the modern record, that is what we do. And we don't think about election cycles or anything that's political.
Okay. So the Fed has set a target for inflation of 2%. Now, can you clarify, does that mean that the inflation rate has to be at 2% before you're ready to move, if you are ready to move, or does it have to be within sight? And what does it mean to be within sight?
So when we change interest rates, that tightens financial conditions, and that in turn affects economic outcomes, growth, labor markets, and ultimately inflation, but with lags that can be long and variable, as Milton Friedman famously said. And the implication of that is that if you wait until inflation gets all the way down to 2%, you've probably waited too long, because the tightening that you're doing, or the level of tightness that you have, is still having effects which will probably drive inflation below 2%. So we've been very clear that you wouldn't wait for inflation to get all the way down to 2%. Our test has been for the past